The big, beautiful bill is now in the hands of the Senate, and it may be a while before it becomes, or some version of it becomes, the law of the land. And here to talk with me about this is Lisa Featherngill. She is the National Director of Wealth Planning at Comerica Wealth Management. Lisa, welcome.
Thanks, Bob. Great to be here.
Oh, it's a pleasure to have you here. It will be a pleasure to have you talk about the big, beautiful bill and where it stands and what you think will stay and how people should be planning for it, if at all.
Yeah, it went through the House pretty quickly. And within a week, it was passed out of Ways and Means and off the floor and over to the Senate.
Well, that's partly
Now,
because, by the way, it's partly because some people didn't read it.
it was lengthy. It's very lengthy.
Over 1,000 pages, I think. Yeah. But anyway, I interrupted you.
No, but so even on the news this morning, I was watching CNBC and they were and there were people on talking about how even the Republican senators are not super excited about it. So there will probably be some changes coming out from the Senate. We're just in a wait and see mode.
So for seniors, for anyone really, don't make any plans based on what may be.
That is one thing I have learned over the years. You do not take the House version or the Senate version and make any plans. At least wait until we've got something coming out of conference committee.
All right. So let's just play a what if game. There are some things in the bill as it currently stands that are somewhat interesting. There's a bonus deduction for seniors, which is being put in place to make up for the president and Congress not to be able to do away with taxes on Social Security benefits in the absence of a new law. So any thoughts about whether the bonus deduction stays?
That's interesting. It's only $2,000 per individual age 65 or over, and it's only for 4 years. It's an additional personal exempt. It's an add-on to the personal exemption. So I don't know the numbers, but based on the number of people turning 65 this year, it's probably pretty significant.
About 4 million people. Yeah.
Yeah.
So, all right. So it stays or goes? What do you think?
It affects a lot of people and it's not a huge dollar amount. I'm going to say it stays.
All right. There has been much talk ever since it was introduced about the SALT deduction going down to $10,000. In the new bill, it goes up to $40,000, I think, somewhere around there. That's stay or go?
That's a tough one. I don't think it's going to look like it looks right now. So when it came out of Ways and Means, it was a maximum of $30,000, but it was going to phase out starting at $400,000. Well, that didn't. To me, when I saw that, I thought if it phases out at $400,000, and it phases out pretty quickly for people who are high earners or who have a lot of real estate property tax, they're going to blow through that $30,000. At least there's a $10,000 cap. So on the House floor, they changed it to a $40,000 deduction with a $500,000 phase out. For the high income earners in California and New York, they're still not going to get a huge amount of benefit out of that deduction. So I don't know. It's got a lot of energy behind it. I'm gonna guess that it changes.
Yeah. All right. And the last thing that people are talking about is the estate tax and whether it gets extended or gets repealed.
Well, in the bill, it says the exemption goes up to $15 million. It's at 13.99 this year. It goes up to $15 million, and then it adjusts for inflation going forward. There hasn't seemed to be much controversy around that. So I think that has a good chance of moving forward, which is, pretty exciting in the business that we're in, because a lot of people had been waiting to see what was going to happen. Actually, a lot of people were motivated to act because they thought that it was going to drop in half on January 1, 2026.
And it's interesting because I just came back from a conference in California where some of the discussion was around whether I should use a SLAT or a CRT or some advanced charitable giving strategies. But maybe the need to do that is less if the estate tax gets extended.
True. But, I've been looking at how often the estate tax laws have changed since the beginning of this decade or this millennium. Think about it. We had we had the big change from 1 million to 5 million. Then it dropped down to 0 for a year. Then it went back up and then it doubled. I just don't think anything is permanent when it comes to estate tax anymore.
Yeah. So job security for estate planning attorneys and CPAs, I guess, too, along with that.
Yeah.
All right. So, Lisa, I want to turn my attention to something that I think is quite interesting in the opportunity that it presents. The RMD age goes to 75 for those who reach age 74 after December 31st, 2032. And there's some planning opportunities that are created because of this increase to the RMD age.
Yeah. So think about it. If somebody retires at 65, 66, 67, somewhere in there, even if they've got payouts for a couple of years, if they're waiting to take RMDs, they might have 3 or 5 years that are going to be really low income because they got nothing coming from their employer. Maybe they've got Social Security, but that's not going to throw them into a high tax bracket. And so there's an opportunity there to accelerate income before taking RMDs. And what it actually will do is if you take the RMDs early, if you need the money, or convert some of the money that's in the IRAs to Roth and use up some of those tax brackets, you'll end up smoothing out the income in the later years because you'll either have lower RMDs and therefore maybe can keep your bracket level lower.
Yeah. So with respect to Roth IRA conversions, two things, at least I think, to consider. One is, do you have outside money to pay for the taxes due? Otherwise, maybe that creates a problem for you. And then secondly, a lot of times people think about RMD Roth conversions with a break-even point, and that there may be a number of years that you should consider before it makes sense. Is that fair to say?
Yeah, normally we think about the break-even point if we're looking at there being a lower tax bracket later. So excuse me, no, let me say that differently. Usually there's a break-even point because you're accelerating the tax expense, right? And so at what point would you have been better off just waiting to take that money? So you have to look at what's your tax bracket going to be down the road versus if you brought in that income through the Roth conversion.
So, and then in terms of having outside money to pay for the taxes due on the conversion, that's an absolute must, right there. It's a non-starter to even think about doing a Roth conversion if you don't have the money outside.
Absolutely. Even if you're thinking about small Roth conversions, you need to have money. You need to have liquidity to pay the taxes up front.
Right. And when I think about the taxes due, there's the tax on the distribution from the IRA. And then perhaps if you have money in a taxable account that you're using to pay for the for the bill due, you might have a capital gain perhaps on the taxes that you use to sell your stock, for instance.
That's right. If you have to sell stocks or something to create the liquidity to pay the taxes, you could be hit with that capital gain.
All
But
right.
the thing to remember is that it's not just the rates, it's the brackets. And one of the things that this the beautiful tax bill does is that it keeps those wide brackets for the lower income tax rates. And so whereas it used to be, you would get into the 39% bracket at about $400,000. And in the current world, you're not even getting into the 37% bracket until you're well above that. So there's a lot of room to plan and to do some good tax arbitrage.
Yeah. So it's hardly an episode of Decoding Retirement goes by where we don't talk about the Social Security Trust Fund and it becoming depleted in 2033 and the possibility of benefits being reduced by 20 cents on the dollar. And you have a contrary point of view on Social Security. And the common advice, Lisa, right, that we get from mostly everyone is delay to age 70 if you can, and rarely are we telling people to claim sooner than that. But eager to hear your contrary
So
point of view.
true. I had somebody run my numbers, right? And clearly, right, if everything goes as planned, it makes sense to wait till age 70, get an 8% bump a year. Now, I'm of the age where full retirement age is 67. So I would have 3 additional years, that would be another 24% income, which sounds great. However, in reading the annual report from the Social Security Administration, I'm a little worried if they hit that, if they deplete their reserves in 2033, which now we have a couple of years worth of them saying that's the case, then they're only going to be able to pay out what is coming in. And that's expected to be 80% of current benefits. So it's almost like a bird in the hand type of thing that maybe you should go ahead and take it earlier because you're getting 100% of something rather than waiting and getting a smaller number.
Yeah. So you're getting 100% for a little bit of time until 2033, at which point you'll get 80% of what you were getting.
That's right. So maybe I would have, let's see, 67, 68, 69. Maybe I would have three or four additional years of 100% versus waiting and getting, 24% extra, but then it's going to go down by 20. I haven't run the numbers, but my gut is telling me that it's going to make sense to go early if I'm concerned about the fund.
Right. Now, there is the possibility, as many people have told us on Decoding Retirement, that yes, there's the possibility that it goes down to 80 cents on the dollar, but more likely than not, someone in Congress, some brave soul who doesn't mind not getting reelected, will vote to put forth a bill that says we're going to either raise taxes or cut benefits. And if we do any of that, it's going to affect younger people in their 20s, 30s, and 40s, perhaps, as opposed to anyone in their 50s, 60s, and older, right? I mean, is that fair to say that if you're a betting person, that it's not going to get reduced?
We haven't had legislation that's passed that's affected Social Security taxation or benefit in a long time. Remember, there was a bill about, I don't know, 5 years ago that there was some discussion about decreasing the benefits and increasing the tax rate on Social Security income. So I think there's going to be more of a sense of urgency as we get closer to depleting the fund. We have, what is it, 5 million people turning age 65 this year, something like that. So it's going to be even more pressure on the fund every year as the baby boomers, more and more start taking Social Security.
Yeah. Lisa, we have to take a short break, and when we come back, I want to talk about your son's most recent graduation and what you're helping him do. Don't go away. Welcome back to Decoding Retirement. I'm speaking with Lisa Featherngill. She's the National Director of Wealth Planning at Comerica Wealth Management. Lisa, before the break, I promised that we would talk about your son who recently graduated from college. And perhaps unlike other college graduates, you're doing something somewhat unique for him that I didn't quite expect. Tell me what you're doing.
So I'm very excited. My son graduated with his master's in accounting. He was a finance undergrad, and I planted the seed a couple of years ago about the shortage of accountants. And so he went ahead and he got his accounting degree, and he's going to work for a CPA firm starting this summer. Well, coming out of college, even if you're making a decent wage, is so expensive. And real estate has gotten so expensive. He's in Raleigh, North Carolina. And while it may not sound really expensive if you're in the Northeast, but to buy a condo in Raleigh is, it's hard to find something for under $300,000. So I am doing something that my mother actually did for me when I got out of college, and it's called a shared equity agreement. So I am putting down the down payment, and he will make the monthly payments on the mortgage. Well, I'm doing a modified version. I'm actually giving him some financial assistance that tapers off over 3 years. But I put everything into writing, what my investment is, what my expectations of him are, and how we'll split the profits going forward. So I put the upfront money in. I said that any additional improvements, we'll decide how that's paid. But if I pay for it, it obviously increases my investment in the property. And when the property is sold, I get my investment back, pay off the mortgage, and then we split 50-50. So it gives him a chance to also have a stake in the appreciation of the property. And he's super excited. He's going to have a townhouse not too far from where he works, and he's staying where he went to school. So yeah, it's a nice thing to be able to pay it forward.
That's really fantastic. Does your husband know about this deal, by the way?
Yes, he does.
All right, because you sounded like you made the agreement
Well,
solo.
that's true. I did write up the agreement, and he and Walker and I are on the deed and the mortgage together. But here's an interesting thing that I hadn't thought of, and this actually my sister-in-law is a realtor and told me about this when she said, "Think about how you want to title the property." Right. So if I was to pass away, I don't necessarily want this property being joint, like with right of survivorship, or my investment would automatically go to my son. I want my husband to have the opportunity to get that investment back. So we title it as tenants in common.
That's a that's great. Well, but so you bring up an interesting point, which is in order to do these things, you need to have access to good advice, right? Like that to me is almost the hurdle that most people face when they think about what could I do to help my son, daughter, whatever it might be. And having access to advice goes a long way toward helping you solve these problems, overcome these hurdles.
Well, and when you think about it, I've been in this business almost 40 years and I've had a shared equity agreement, but the whole idea of how to title the property didn't even cross my mind until a couple of weeks ago. So you really have to have advice and probably from more than one person.
Lisa, I want to turn my attention back to retirement. I'm fond of quoting research that says spending declines on a real basis throughout retirement, but that's not the case with your client base. Tell us what you're seeing about how retirees are spending money when every day is Saturday.
Well, very early in my career, a client said to me, "Lisa, my expenses are not going down in retirement because every day is Saturday." And the clients that I talk to say, I'm going to travel more. I'm gonna, indulge in my hobbies more. And I think that if you don't have 8+ hours that are dedicated to the office where you're not shopping or traveling or spending money on other things, there's just a lot more time to spend money. And, this generation is more spenders than maybe the earlier generation. So, and that doesn't even factor in the health care. We're living longer. We're going to have more money that we're spending on healthcare, whether that's cosmetic or medically necessary. There's just a lot more opportunities, I think, to spend money than there ever were.
Yeah. So the implications of that, Lisa, I think are twofold for me. One is you might need to save even more than you thought, given that you're going to spend more than you anticipated. And secondly, maybe you should work a little bit longer to save that much more so that you can enjoy your years of that spending.
So there are a couple of things you can do to affect that expense number. One of them is to work longer, so your net expenses are less, which means that you have more money for later on. Another thing is just, budget so that you are spending to a certain amount. It used to be people talked about the 4%, the endowment method of drawing down your assets 4%. I don't think that works so well anymore, but at least having some kind of a estimate, a projection of what your income and expenses are going to look like. So cash flow and balance sheet year by year really helps to put things in perspective.
Yeah. I always think that the hardest part about these factors is your life expectancy, Lisa, right? Which is to say, I don't know if I'm going to live 10 years or 20 or 30 or 35 years in retirement. And to me, that makes all the difference in the world is we're trying to make something certain out of uncertainty. How do you deal with all that?
I try to be as conservative as possible. So with clients where we're running the numbers, we run them out to age 95.
And that
So that,
that probably scares some people, right?
it does. It does, but better to oversave and better to be conservative than, as my clients used to say, I don't want to be eating dog food when I'm 85 years old.
Yeah. I used to think that if instead of mutual fund companies showing people on yachts and beaches in retirement, that they should show people maybe eating dog and cat food to say, if this is what you want to have happen, fine, just keep doing what you're doing. But if you want to live on the yacht and walk on a beach, you should save a little bit more, maybe.
Now, if you look at the stats at how much people have saved for retirement, that's probably a really good idea to start influencing behaviors.
I can't get anyone to think that they want to run that ad for what it's
Maybe
worth.
if you're,
All right, but in retirement, right? A lot of folks have the ability maybe to control some of their destiny. You're an avid biker. I'm an avid biker. The need to stay healthy in retirement. If you follow Peter Attia and this notion of being having functional sort of strength and being able to lift groceries and lift grandchildren and walk up steps, really important in retirement. I mean, obviously you practice what you preach.
Yeah, I wish I didn't have such an expensive hobby. They always say with bikers, the number of bikes you need is the number you have plus one. And and so
I know.
maybe take up running. That's pretty cheap hobby.
Yeah,
But
I'm
yeah,
afraid my wife and I have somewhat maybe two expensive hobbies. One, I have a number of bikes in my fleet, gravel, road, and mountain. And then my wife is a stand-up paddleboarder, and she has a number of paddle boards in our garage. So we can never downsize because there's not enough. There's no space would be big enough except for what we have for all our toys.
Yes, but you know what? I think it keeps you happy, it keeps you healthy, and that's really the name of the game.
Yeah, we've almost run out of time, but as you think about happiness in retirement, I'm often reminded, Lisa, there was a study done by the Center for Retirement Research at Boston College that said, by and large, most people, irrespective of how much income they have in retirement, are satisfied if three things are true. One is that they retired on their own terms. Two, that they're in good health. And three, that they're married. And I've always debated the third one. Just kidding.
I might have been a man who said that.
All right,
No,
Lisa, I think we've run out of time, unfortunately, but I want to thank you for sharing your knowledge and wisdom with our listeners and viewers. It's so greatly appreciated. Can't wait to have you come back on a future episode.
Really enjoyed it. Thanks, Bob.
So that wraps up this episode of Decoding Retirement. We hope we provided you with some actionable advice to help you plan for or live in retirement. Don't forget, if you've got questions about retirement, you can email me at yfpodcast@yahooinc.com. And don't forget, you can listen to Decoding Retirement on all your favorite podcast platforms.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.